I am going to give you the 8 most important keys that successful investors like me use to invest our money. Number 1. Invest using the margin of safety. The first rule on investment is don't lose money. And the second one is don't forget the first rule, and that's all the rules. If you buy things for far below what they are worth and you buy a group of them, you basically don't lose money. It is important to use what I call margin of safety. Most investors get excited about market rallies and decide to invest all their money when the stock keeps going up. They don't analyze the business and don't care about the price they pay. This has caused stock market bubbles such as the dot-com bubble in the year 2000. This reasoning is usually wrong and is the reason why most investors lose all their money. The greatest opportunities in the stock market usually appear when stocks are at low levels, when most investors are afraid to invest at those times, as negativism and pessimism floods the market or economy. That is when good investors like me are more likely to find this margin of safety, a big difference in your favor between what you are paying and the real value of the company you are buying at that moment. Second one, train your temperamental quality. The most important quality for someone who wants to invest in Wall Street is the temperamental quality, not an intellectual quality, because you don't need tons of IQ or intelligence in the investment business. I mean, you have to be smart enough to know how to tie your shoelaces, but you don't have to be able to play three-dimensional chess or be in the top leagues in terms of mathematics, calculations, or anything like that. You need a stable personality. You need a temperament that gets no pleasure from being either with the crowd or against the crowd. Because this is not a business in which you take surveys. It is a business in which you have to think independently. Ben Graham said that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts in your reasoning are right in what do you do. In the 2020 health crisis, Nike shares fell 45% in a few days. After most investors panicked, sold all their shares. Investors with temperament and independence of thought were able to isolate themselves from the market noise and appreciate the quality of the company, its competitive advantages, and invested in one of the best companies in the world, taking advantage of the large margin of safety offered by the stock at the time. The company's shares rose more than 160% in the next 20 months from hitting lows in March 2020. Number 3. Focus on the company behind the stock. Most investors focus on what stocks will do in the next few days or months. They use all sorts of arcane methods and charts to try to figure out what their stock prices will be. This is a mistake and a total waste of time. They should actually feel like they own a piece of a business each time they buy a stock. The true test for an investor to know if he is investing correctly is to feel that he doesn't care at all if the stock market closes tomorrow and he can't see his stock for the next 5 years. The only thing the stock tells me is the price. I may check the price from time to time to see if it is extremely high or extremely low, but prices alone tell me nothing about a company. 4. Evaluate companies in an appropriate way. The facts and numbers in the annual reports of a business do tell me something about them, but the share price tells me absolutely nothing about a business. Good investors value businesses based on the fundamental analysis of their earnings and annual reports. Thanks to ratios such as the P ratio, you can know if a company is expensive or cheap. This ratio relates a company's earnings per share to its share price. A company with a share price of $200 and earnings per share of $10 is at a more attractive valuation than a company with a share price of $100 and earnings per share of $2.50. You have to look at the company's earnings, their future prospects, management team, and many other things. Don't just look at the share price, as most Wall Street investors do. I prefer value a stock or a business first and not even know the price, so that I'm not influenced in establishing my valuation, and then look at the price later to see whether it's way out of line with what the real value of the business is. Number 5. Avoid excess of information and the Wall Street hype. A good investor does not need to be constantly informed about what is happening on Wall Street. On Wall Street, there is too much stimulus and too much buzz, which can make you lose your focus and poor focus does not lead to long-term profits. You have to focus on what companies are worth and their fundamentals, nothing else. And I don't need to be in Washington to find out how much the Washington Post newspaper is worth, and I don't need to be in New York to find out how some other company works. I can find out from their annual reports. It's just an intellectual process. Next one, buy what you know. It's as easy as defining your area of competence in valuing companies, and then within that area of competence, finding what sells for the cheapest price relative to value. And there are all sorts of things I'm not competent to value. I've never bought a technology company. In 30 years of investing, not a single one, because I don't understand them. For example, I have never invested in Google. It is a great company, and surely we are in the technological revolution. But that doesn't matter to me. I don't have to make money on every game, only in what I am able to understand. For example, Costco is a company that everyone knows. Everyone has been in one of their warehouses. It is a simple business to understand. And for any citizen, it was easy to see the great success of its products and the continuous opening of stores all over the country for several years. Costco's stock since 2000 has increased almost tenfold. Its profits have continued to grow each year, and it's a company as fantastic as simple to understand. Number 7, learn to do nothing. In the stock business, literally every day investors have thousands of offers from major US companies being offered at a price that changes daily. You are not forced to make any decision, and you don't have to do anything in a forced way. The world of Wall Street is like baseball. The market is just there to throw balls at you non-stop. However, you don't have to do anything. In this business, hitting is not mandatory. In the stock business, they throw us a ball from Coca-Cola at 58. Another from General Motors at 42, but you don't have to swing. They may be good companies, but if you don't know enough about them, you don't have to swing. You can sit and wait and watch thousands of pitches until you finally get the ball that just interests you, something you understand, and then you swing hard. And you may not pitch for 6 months. You may not pitch for 2 years. Sometimes it's very boring. It bores most of the people. Number 8, stay away from irrelevant facts of speculators. Many investors, focusing on all sorts of variables, focus on whether you buy shares on Tuesday and sell them on Friday, or whether you buy them in election years and sell them in other years. There are all kinds of variables, but they are not important. If I was told to take a good chance at a quality business, would it make any difference to buying a Tuesday or a Thursday, or an election year? Stocks are just parts of a business. Don't forget to hit the like button and to subscribe and activate all the notifications of this channel. See you in the next video. Greetings and good investments.